For the last 20 years, the smartest financial advice on the planet has been the same three words: buy index funds. And honestly, that advice was correct. Low fees, automatic diversification beats most active managers over time. It was the closest thing to a free lunch that finance has ever produced. But here's the problem nobody is talking about. What happens when everyone takes the free lunch at the same time? Because right now, over $13 trillion with a T is sitting in passive index funds, and that number is growing every single month. And I'm here to tell you that this isn't just a statistic, it is a slow-moving structural problem that is quietly making the entire stock market more fragile, more irrational, and more dangerous. And I can prove it. To understand the problem, you first need to understand the mechanics. When you buy an S&P 500 index fund, you're not making a decision. You're not saying, I think Apple is undervalued or I think Tesla is overpriced. You're not saying none of that. You're just buying everything in the index, automatically, in proportion to its size. That last part is important, in proportion to its size, because the S&P 500 is what's called market cap weighted, which means the bigger a company gets, the more of your money goes into it, automatically, without anyone asking questions. So right now, the top 7 companies, Apple, Microsoft, NVIDIA, Amazon, Alphabet, Meta, Tesla, make up over 33% of the entire S&P 500, which means when you put $1,000 into a standard S&P index fund, 330 of it goes into just 7 companies. The other 670 gets spread across the remaining 493. That's not diversification, that's concentration with extra steps. And this is where it starts to get dangerous. Here's a question nobody asks. Who actually decides what a stock is worth? The answer is supposed to be active investors, analysts, portfolio managers, people who read earnings reports, build financial models, and decide whether a company's stock price reflects its actual value. That process is called price discovery, and it is the entire reason markets are supposed to work. But that process is dying. Because as of today, 63% of all U.S. stock fund assets are now held in passive index funds. 63%. That is the majority of the market. And passive funds, by definition, don't do price discovery. They don't care if a company is overvalued or undervalued. They just buy whatever is in the index in whatever proportion the index dictates. So think about what that actually means. When money flows into index funds, which it does every single month from millions of 401k contributions, that money buys Apple, Microsoft, and NVIDIA, not because anyone decided those companies are worth buying, but because they're the biggest. And because they're the biggest, the buying makes them even bigger. And because they're even bigger, the next round of passive inflows buys even more of them. It's a feedback loop. And it has almost nothing to do with whether these companies are actually worth what the market says they're worth. And here's the part that should genuinely alarm you. When price discovery breaks down, when prices stop reflecting reality, markets don't become more stable, they become more explosive. Because eventually, reality catches up, and it never catches up gently. Now let's talk about what happens when markets go down. One of the selling points of index funds is liquidity. You can sell anytime, your money is always accessible. And in normal times, that's true. But in a crisis, something very different happens. Because when markets start falling and people panic, they don't just sell their individual stocks, they sell their index funds. And when you sell an index fund, the fund has to sell everything inside it: Apple, Microsoft, NVIDIA, the good companies and the bad ones. All of it at the same time, which means in a sell-off, index funds become forced sellers of every stock in the index simultaneously. And because passive funds control the majority of the market, that forced selling is enormous. And here's what makes this worse. Because passive funds are market cap weighted, the biggest stocks get sold hardest. The same stocks that got bid up the most on the way in get dumped the most on the way out. What you end up with is a market that goes up faster than it should and comes down harder than it should.
The index fund structure itself amplifies every move in both directions. We saw a version of this in 2020. We saw it again in 2022. And each time the recovery required either the Federal Reserve stepping in or a wave of new passive inflows to restart the cycle. That is not a healthy market. That is a market that is becoming structurally dependent on constant inflows just to hold itself together. Let's go back to those 7 companies: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla. Over 33% of the S&P 500. And because the S&P 500 is the benchmark that almost every index fund, pension fund, and 401k tracks, these 7 companies are essentially the market. Now ask yourself, what do all 7 of these companies have in common? They're all tech-adjacent, they all depend on cheap capital, they all have enormous exposure to AI investment cycles, and they all have valuations that are pricing in decades of future growth. Which means if something goes wrong, a rate shock, a regulatory crackdown, an AI bubble that deflates, it doesn't just hurt tech stocks, it hits the entire index. Every passive investor in America takes the hits simultaneously. Every 401k, every pension fund, every retirement account that was told to just buy the index. The risk isn't diversified, it's concentrated. And it's been concentrated by the very product that was designed to protect ordinary investors from Wall Street's worst instincts. Now let me be clear about something. I'm not saying index funds are bad. For the average person with a 30-year time horizon, index investing still makes more sense than most alternatives. What I'm saying is something different. I'm saying that when a strategy becomes so dominant that it changes the structure of the market itself, that's when the original logic of the strategy starts to break down. Index funds work because active managers do the work of price discovery. But if passive investing keeps growing and active investing keeps shrinking, eventually there won't be enough price discovery left for markets to function properly. The academics have a name for this. It's called the passive investing paradox. The more people index, the less efficient markets become, until indexing itself stops working. We're not there yet, but the data suggests we're moving in that direction faster than most people realize. And the uncomfortable truth is, the product that was designed to protect ordinary investors from Wall Street's worst instincts may be quietly creating the conditions for the biggest systemic risk we've ever seen. Not because the product is a scam, but because when 63% of the market stops asking questions, nobody's left to notice when the answers stop making sense. The free lunch isn't free. It was just being paid for by the shrinking number of people still doing the work. And when they're gone, when the last active manager finally gives up and buys the index, we're going to find out what a market looks like when nobody's watching. And by then, it'll be too late to ask questions.